All right, let's dive right in. Today, we're looking at two massive stories that, on the surface, seem like they're happening in completely different universes. On one hand, you have a global debt crisis that's reaching truly historic levels. And on the other, a really intense supply squeeze happening in the silver market. But what if I told you they're not separate stories at all? In fact, they're on a collision course. And understanding how they connect is, well, it's absolutely crucial for understanding what might be coming next. So let's start with a number. A really, really big number, $318 trillion. That, according to the Institute of International Finance, is the total amount of debt in the world right now. It's a number so huge, it almost feels fake, right? It's hard to even wrap your head around. But it is very, very real. And it's the engine that's driving our entire story today. So how do we make a number that big actually mean something? Well, let's try an analogy. The entire global economy, everything we produce in a year, is worth about $105 trillion. But we owe more than 3 times that amount. So it's kind of like you're earning 50 grand a year, but you've got 150 grand in credit card debt. You're just stuck making these ever-growing minimum payments on a balance you know you can never, ever pay off. That's the tight spot the entire world is in. Okay, now let's zoom in a bit because the epicenter of this whole thing, you could argue, is the United States. Now look, debt is a global problem for sure, but the sheer size and the way America's debt is structured, well, it has these unique ripple effect consequences that really set the stage for everything else we're going to talk about. Now this is a number that should really grab your attention, $1 trillion. That's how much the US is now spending every single year just on the interest payments for its national debt. I want to be super clear here. This isn't paying down the debt itself. This isn't for building roads or funding schools. This is just the fee for being in debt in the first place. To put that $1 trillion into perspective, think about this. It's now 13% of the entire U.S. federal budget. Those interest payments are eating up more taxpayer money than Medicare, and they're getting dangerously close to what's spent on the entire defense budget. And what's really wild is that the government's own numbers show this cost is on track to pretty much double in just the next 10 years. This whole trajectory is leading to something economists have a pretty scary name for, a debt spiral. And it's exactly what it sounds like. It's a vicious feedback loop. It's when you get to a point where you have to borrow new money just to make the interest payments on your old debt. So the problem doesn't just get bigger, it starts to speed up, to accelerate. And according to the analysis we're looking at, this is the trap the US is now walking into. So this all leads to a really important question. When governments throughout history get themselves backed into this kind of corner, what do? I mean, how do they get out of it? Well, history shows the answer is almost always the same. They don't just default on the debt. That would be a political and economic disaster. No, they take a different route, a quieter one. They just create more money out of thin air to pay the bills. And of course, when you do that, you devalue every single dollar that's already out there. And when savvy investors see that coming, they start running towards hard assets, things you can't just sprint into existence. And that is the perfect pivot to the second half of our story. We're going to shift gears now from this huge macroeconomic problem of global debt and zoom in on the very specific situation in the silver market, where a totally different kind of crisis has been quietly building for years. So here's the core of the issue for silver. For 5 straight years, the world has used more silver than it has produced. And I want to stress, this isn't just a blip on the radar. This is a long-term structural deficit. To give you an idea of the scale here, just in 2024, the world is expected to use 282 million more ounces of silver than will be mined or recycled. That is a massive, ongoing imbalance. So you might be asking, where is all this silver actually going? Well, it's being eaten up by the very technologies that are building our future. Solar panels are the #1 consumer by a long shot, but silver is also absolutely essential for electric vehicles, for AI data centers, for 5G networks, and for all kinds of medical devices. You see, silver is the most electrically conductive metal on the planet, and for a lot of these cutting-edge uses, there just isn't a good substitute. And this is a really, really critical point to understand. When someone buys a silver coin for an investment, that coin still exists. It can be sold back into the market later on. But when silver is used in a solar panel or a tiny circuit board, it's used in such small amounts that it's basically gone forever. It's not economical to recycle it, so it gets consumed. And this creates a permanent one-way street, just draining the world's supply. And what's the result of draining that supply for 5-year street? Well, the inventories are collapsing. Take the COMEX exchange in New York. It's one of the main hubs for physical silver. Its warehouse stockpiles have plummeted by 27% since the beginning of 2021. The actual physical metal is literally walking out of the vaults. And this, right here, is where our two stories slam into each other. The fear that's being created by the global debt crisis that pushed into hard assets is now flooding into a silver market that is already stretched to its absolute limit because of this industrial demand boom. So you've got these two incredibly powerful but totally different forces hammering the market at the exact same time. On one side, you have the safe haven buyers, people who are grabbing silver to protect their savings from being devalued. And on the other side, you've got these industrial giants who have to get silver to build their products. One side wants to hoard it, the other wants to consume it. And they're both fighting over the same shrinking supply of physical metal. And this gets to a really fragile point about the modern silver market. It works a lot like a bank. The paper market, futures contracts, ETFs, it all works on a fractional reserve system. What that means is there are way, way more paper claims to an ounce of silver than there are actual physical ounces to back them up. The whole game works just fine, as long as only a tiny number of people ever ask to take delivery of the real thing. And according to the analysis, that system is flashing some serious warning lights right now. First, there's a weird thing happening called backwardation. All that means is that people are willing to pay more to get physical silver in their hands today than for a contract that promises it to them in the future. That's a huge red flag for a shortage. Second, premiums, the extra bit you pay for an actual coin or bar, they're spiking. And finally, lease rates, which are basically the interest rate you pay to borrow physical silver, they've hit some crazy high levels. All these signals are screaming the same thing. There's a severe shortage of metal that's actually available. So the system is clearly under a lot of pressure. The big question is, how does this all play out? How does this story end? The source material we're looking at basically lays out 3 different ways this collision of crises could resolve. Okay, scenario 1 is what you might call the nightmare squeeze. This is where a panic for physical metal just shatters the paper market. Prices could go vertical, and industrial supply chains could grind to a halt. Scenario 2 is the slow grind. This is a more orderly process where the price just steadily climbs to a new, much higher level as these deficits continue. And then there's scenario 3, the soft landing, which is probably the least likely. This would require some kind of magical tech breakthrough that reduces silver demand, right? As we discover a bunch of new mines. So let's just boil this all down to the key takeaways. First, global debt is at a point that historically leads to currencies being devalued. It's just not sustainable. Second, the silver market has a deep structural supply problem that doesn't have an easy or quick fix. Third, you've got these two massive forces, fear and industrial necessity, colliding in this very fragile market. And fourth, the market is already sending up flares, warning us that the physical supply is under some serious stress. Ultimately, this whole tale of two crises leaves us with one big, fundamental question to chew on. As this mountain of global debt keeps growing and the solutions to deal with it get more and more extreme, what is the true value of tangible, physical assets, of real stuff, in a world where our trust in all those paper promises might just be starting to fade? It's a question really worth thinking about.